It's Tayo here. So we just finished the business finance clinic this evening, and I thought I'd do a quick recording of the slides on the special feature this month, which is self-assessment tax returns. And the reason why I'm doing this is because I know a few people wanted to come and join us and they couldn't join us for the session. Those that were able to join us live were able to ask me questions. And just wanted to say that if you're watching this later and you have questions about self-assessment, tax returns, especially as if you're in the UK, we've got 2-3 weeks to the deadline for the 2019-2020 tax returns. Do ask your questions right here in the group. And I will answer every single one of them. So if you missed it, this is your opportunity, if you like, to catch up. So I'm just doing this recording and I'm going to go through the slides now. Let's get started. Right. I think we better start from the start. So this is a business finance series, as you know, and we're talking self-assessment and what you need to know. What is self-assessment? So I like to just go through the basics first. You might already be familiar with some of the things I'll be sharing, but bear with me because I know for some people it might be the first time that they're having to do self-assessment because they're new to business or they're just newly self-employed. Just a quick disclaimer as we start. I am an accountant. I'm a management accountant. I do not practice as an accountant at the moment, but I've got all the knowledge, and I still have to do my continuous professional development. So I'm quite up to date with taxation, but I do not practice as a tax accountant or even an accountant at all. As you know, I'm a business performance coach, but one of the, if you like, hats I wear is the fact that I am a management accountant. So a bit of a disclaimer is the fact that all I'm sharing today, is to educate you, is to raise awareness, and to help you to understand some of the terms around um, business taxation, sorry, not business taxation, but self-assessment tax returns and how it is calculated and why. So just have that at the back of your mind. This is not all the information, but it is going to raise your awareness and hopefully answer some of the questions that you have about it. So let's go on to the next slide. What is self-assessment? It's a system that the government uses to collect income tax. It's as simple as that. If you're employed with somebody, if you're on a payroll with a company, for example, they have a duty to deduct your tax before it is before you get your money, before you get your, that's why we call it the net income. Before you get your income that you're free to spend any way you want, the tax has already been taken out. But if you work for yourself, all the money comes straight to you. So the government doesn't have any other means of getting the tax out of the income that you have. So the only way they can do that is through your self-assessment tax returns. And the kind of earnings or income that the self-assessment is based on is earnings from employment, earnings from profits you make when you're self-employed, or from your pensions or rents, if you're a landlord, or interest on maybe investments that you've made, and dividends from your company, from your limited company. So if you are a director of a company and you're taking money out of the business, maybe some of the profit, then that is going to go on your self-assessment as a dividend taken. And why does the government do this? Why do they take all our money? It feels like it sometimes. Why do they take so much taxes from us? It's because they need to fund public services and the national debt and a lot of other things. So, they do the roads, they provide, they give money to local councils to do different things. They pay for teachers in state schools. They pay for education, paying the teachers. They fund so many things that we need to run the economy and to run the country properly. So they need money for that, and they get the money from us through the income tax system. Now, this is a very important diagram, and this is about when. This is a critical question that can be very confusing for people, and I hope I can help to clarify this. When is tax due, and what period am I paying tax on? What does it mean? So I'm hoping to clarify that to you. Um, Now, I'm going to use the example of the current tax year, the current tax that is due, the tax returns that are due at the end of this month, 31st of January 2021. So tax return period is usually what we call the tax year, and it starts from the 6th of April of every year and ends on the 5th of April of every year. Obviously, I'm talking about UK only. It's 6th of April to the 5th of April. So the tax for the 6th of April 2019 to the 5th of April 2020 is due for payment in January of the following year, by the 31st of January of the following year. And that's also the deadline, the last deadline for submitting your tax returns. So the process is you have the tax year ending, so say 5th of April 2020, and you have up to the 31st of January of the following year to submit your tax returns and pay your tax, the taxes that are due. After that, if you don't have an arrangement with HMRC for the payment, you start to earn interest on the monies due. Now, there is an option. It's not an option. If you want to use the paper return, the paper tax return, and you're not doing it online, the deadline is the 31st of October. And if you choose to do it online, which most people do now, you've got an extra time up to the last day, the 31st of January 20 of whichever year, to make your pay to do your returns and make your payment. So that is a whole almost 9 months you have, just over 9 months that you have to submit your returns and make your payments. Of course, you can submit your returns anytime before January, and they will gladly take your money as well anytime before January of the following year. So hopefully that helps you to understand how the tax period and the deadlines work for the self-assessments. So the question is all your income taxable? I went through a list of all the earnings that are taxable. But the simple answer is no, not everything you earn is taxable, because there are things like tax allowances and tax relief. And I'm hoping that I can help to explain this in a very simple way. Your tax allowance is an amount of taxable income that you can have tax-free before any tax is deducted from your income every tax year. This is a fixed amount that the government decides on, oftentimes, in the years before. So they would say for the next tax year, or for the tax year in 2022-23, the tax allowance is going to be a certain amount. Most people qualify for one or more tax allowances, and I'll share some of the tax allowances in a minute. Then you have tax relief for business expenses. The government allows us to take off most of our business expenses. There are a few things that do not qualify for this, but most of our business expenses can be deducted before the tax is calculated. Of course, tax relief is not available on our personal expenses, so it's important to bear that in mind. Only things that are business related can be deducted. Now, so these are some examples of taxable allowances or tax allowances. You have the personal tax allowance, which is available to all of us. For the tax year 2019-20, 2020-21, which is the one we're in right now, is 12,500, which means for the first 12,500 of your earnings, you do not need to pay any tax at all. That's fantastic. But that's only if your income is below 100,000. When your income goes over 100,000, then that personal tax allowance of 12,500 reduces. And then the different things like the marriage allowance, the personal savings allowance, the dividend tax allowance. If any of this applies, I'd say just find out a bit more about it and see if you can take that off your tax self-assessment. Like I said, I just want to raise your awareness to some of these things. And so how is your tax calculated, your income tax? It's basically your income less any relevant expenses. And it's only payable if you make a profit after all of that. Every year we have different tax rates. 2019-20 and 2020-21, they are roughly about the same. Actually, they are the same. But it's very important, depending on the tax period you're looking at, that you're looking at what the exact tax rate is. Now, something interesting or something that is worth noting about this is that, as I said, the first 12,500 of your income is actually tax-free. So that means the rate of tax on that is 12,500. And I did mention that your personal tax allowance, which is a 12,500, starts to reduce or is reduced if your income is over 100,000. Now, any income over 12,500 up to 50,000 pounds is taxed at 20%. Any income after 50,000 pounds up to 150,000 is taxed at 40%. And so on. Over 150,000 is 45%. So but it's not everything you earn up to 150,000. It's everything between, everything, for example, let's have a look at this. So if you're on a salary, sorry, not a salary, but if your income is 110,000, you would first of all have the 12,500 off, and then you pay 20% on the income between 12,500 and 50,000, and then you pay 40% on the income between 50,000 and 110,000. So that's how it kind of accumulates with different percentages up to the amount of your total income. When is payment due? Payment is due by the 31st of the following year for the tax year on the previous year. So 2019-2020 tax year payment is due by the 31st of January 2021. The 2020-2021 tax year, which ends on the 5th of April 2021, is payable in January 31st, is payable by the 31st of January 2022. And then there is something called the payment on account. Now, HMRC wants to help you. They really do want to help you to control your cash flow. They want you to put money on account with them to ensure that when it comes to paying your taxes, you are not going to have problems. You're not going to be hit with a big bill. And so from the second year of self-assessment, you have to start paying money on account. And this is usually based on your previous year's income. So if you submit your self-assessment, they have a look at it and they ask you to pay 50% of that income, of that tax, of the tax that's payable on that income in July. You're paying it on account against the tax of the next tax year. So that by the time you get to January, you're paying 50% again, and all of that is then deducted from your tax return. So that way you're kind of pacing yourself through, and you're not being hit with a huge tax bill at the end. But the interesting thing is, and the very obvious thing is, obviously helps the government as well, because they get money in quicker, and it reduces for them bad debt, having to chase people for money. This is not applicable if your tax is less than £1,000. They will not ask you for money on account if your tax is less than £1,000. Or if you have a job, your income is such that some tax is deducted at source. So such as PAYE. So if you have a job and you're doing your business part-time, if some of the tax is deducted, if a lot of your tax, roughly about 80%, is deducted at source, HMRC will not ask you to pay on account. And this is simply because they know the employers will get them the money, the bulk of the money from your payroll every month in advance anyway. So a few things are good to know. Good to know the government in 2017 introduced something called the trading allowance. This is for people who have casual businesses, casual income, maybe from their hobby, maybe you teach children how to cycle and just charge a small amount for it, or you sell homemade goods like jam jar and jars of jam, or you bake and you sell to friends and family, but just casual business, right? People that have that, the government introduced a new trading allowance for them in 2017. You can get a tax-free income of £1,000. What this means is that if your income from your business, say you're selling jars of jam, and you have an income of 2,500 in that tax year, they would not tax you on everything. Of course, you always have the option of deducting your business expenses, but they've also said you can have a tax-free income of £1,000, of up to £1,000, and that means that you can deduct that £1,000. The first £1,000 of your earnings is not it. Well, let's say it's tax free. You don't have to pay tax on it. But the trick for them and for us to also know is that you can't also take off your business expenses at the same time. It's either or. So it might make sense sometimes to use a trading allowance. If your income, for example, from your casual business is 2,500 and your expenses is £500, just the jars, it just cost you £500. Your profit, your income tax will be calculated on your profit of £2,000. But then you have the option of not using the business expenses of £500, but using this £1,000 tax relief or trading tax allowance to reduce the amount of tax you pay. Because if you take the £1,000 of the 2,500, then you only pay tax on 1,500. Now, I hope I've not managed to confuse you, but I gave that example to show you that sometimes it might make sense to use a trading allowance and sometimes it won't, because if your expenses is more than it's for example more than £1,000, it might make sense to just use your expenses instead of using the trading allowance. You can't use both. And if your income is less than £1,000 anyway, you probably don't need to do you don't need to report it, because your trading allowance actually, it covers the £1,000. Another thing to bear in mind, working from home. If you work from home, you can claim a portion of your household expenses, things like your heating, your council tax, your rent, your mortgage interest. You can claim a portion of it as business expense. This is usually prorated as a percentage of your floor space that you occupy, or number of rooms, or you might choose to use HMRC's flat rate. HMRC has a simplified expense, something called simplified expenses. You can Google it and you go to the HMRC website to find out more information. But there is a flat rate. If you don't want to bother with all the calculations, there's a flat rate there that you can use. A very good source of information is this HMRC Business Income Manual. You can check that out. Motoring as well. You can claim business expenses for a portion of your motoring expenses if you use your car for your business activities. It covers things like your petrol and diesel and the repairs to your car. Again, you can claim a proportion of actual use. So you could say 20% of the time you use your car for business. Of course, you have to be able to justify it, and HMRC do come nosing around sometimes. They won't follow you around, but they might want you to explain and justify the amount that you put on there. So you can use that. You can calculate or estimate a percentage, or use HMRC flat rate per mile. Again, you can check this information on HMRC's Business Income Manual. Pensions is an interesting one. There is state pension, which we most people contribute to, especially if you are in employment or in some kind of employment. The national insurance we contribute to our state pension, but the government also wants to encourage us to contribute um, to personal pension and they give us 20% tax relief on our personal pension contributions. That increases, if you like, the amount of tax um, allowance. You know, it's how do you say, it reduces the amount of tax that you have to pay. So, for example, if you do a £600 contribution into your pension, you get tax relief of 750. And actually, the government tops up that money with your pension company. So it's a very important opportunity we have. If you're not already doing so and you're able to, I really strongly recommend that you start to contribute to your personal pension because of this 20% tax relief you get on your pension contributions. Now, check this with your financial advisor, find a good one, and well, follow the advice on that. Other things to note, student loans. If you have a student loan, it does come to bear on your how your tax returns are done. So seek advice on that. It's very important. I forgot to add on here, but if you do charitable donations as well, it really does help. So again, check that out when you're filling out your tax returns or submitting the information to your accountant. An important document that you get after you've done your tax returns is called the SA 302. If you're self-employed or you're partly self-employed, it's very important that you keep that because that is your proof of income. Because you know, if you are working for someone else and you want to get a mortgage or a loan, they'd often ask for your P60 because that for them is proof of your income. If you're self-employed, um, then there is no P60 to give. Your SA 302 is what they would be asking for. The P60, if you're partly employed with someone else and you have a P60, it won't show your full income. But because your self-assessment, your SA 302 would have your employed income and it would have your business income on it, or your self-employed income as well on it. It would show the full picture of your income. And so you need to keep that for your records. You might need it. If you have never paid income tax before and you are now self-employed, you need to register with HMRC. That's very important. A few quick things and my advice to you. One is get a good accountant. This could potentially save you hundreds, if not thousands of pounds. It would save you a lot of headache. If HMRC comes knocking, at least you have the peace of mind that you've done it correctly, and it would save you a lot of time. You can spend the time on your business instead. A good accountant doing your self-assessment will cost roughly about £250. It could be less, it could be more, but on average, it will be something like that. So get a good accountant, get recommendations for a good accountant. And if you're doing it by yourself, make sure that you're using the latest HMRC guidelines and or the latest guidelines from reputable sources. That's important. Another very important point is to keep your business records. HMRC expects you to keep all the records, all the supporting documents, your receipts, and how you did your calculations for your self-assessment for up to 22 months. For up to, well, at least 22 months. Within that period, they can come and ask about how you calculated your tax and expect to see the backup documents for it. If you are running a limited company, the timelines are slightly different. It's 6 years. You've got to keep your records for at least 6 years if it's for a limited company. But for your self-assessment tax returns, you must keep your records for at least 22 months. For further help, go to HMRC website. Like I said before, they've actually made it easy. They've made it easier for us because it ensures that they get the money off you, the correct amount of you first time around. So there are lots of examples on the HMRC website. There's short film guides. Watch those, enjoy watching them. And I've also, I didn't put this together. It's just a resource I found, and I find it's really useful for people that are self-employed. So if you note down this link and you search for it, download the PDF document. It would really guide you through so many questions that you might have about self-assessment and your finances and things like your national insurance and what you need to do with HMRC and how what HMRC expects from you. So you can download this document to help you support you with that. And that's it really. I do hope that you have found that I do hope that you found that useful. Like I said, if you have any questions, do post it down in the link, sorry, down in the comments below this video or in the group. If you're watching this elsewhere, post it in the Business Health in the Business Health Club group on Facebook, and I will answer your questions. And if you know anyone that you feel needs to watch this, do invite them into the club, the Business Health Club, and they can click on the link and get to watch it and ask me questions as well. So it's been my pleasure recording this video for you. You have a wonderful day whenever you're listening to this. Take good care. Bye-bye.